Hello everyone, I hope everyone's doing well. Guys, this might be one of my best videos I've recorded so far. In this video I will be dropping an exact blueprint, an exact step-by-step approach into becoming a profitable trader in 2023. I want you to go ahead, pause this video right now, go grab a notebook and come back because I'm going to talk a little bit mathematics and I want you to write everything down. If there is anything that you don't understand during the video, I want you to pause it, repeat it until you understand it and analyze it. Alright, I want you to DM me in 2023 and tell me that you've made it, and I want us to celebrate together. Go grab a notebook and come back and let's start this video. So guys, before I tell you about this step-by-step approach when it comes to trading, I want to first let you understand something about trading. We have this hustling mindset in the world. We have this mindset that the more you work, the more money you make. So this is why we have all these influencers saying, for example, work 15 hours, 20 hours a day, because the more you work, the more money you make, and to be able to make the maximum amount of money that you could possibly make, therefore you have to put in the maximum amount of work that you could possibly put in. And this is true for almost every single business that I might think of right now. If you're starting, for example, a YouTube channel, the more videos you produce, the more people who will watch those videos, the more money you will make through AdSense. If you're doing a business that requires you reaching out to clients, the more cold emails, cold messages, cold phone calls that you do, the more money you will end up making. So this is kind of true, of course, unless you hire and you delegate. However, for most of you starting out, you still don't have these resources. So the more work and time you put in, the more money you make. And therefore we have a quantity model and a quality model. Usually, let's say I have a social media agency, and in order to gain clients for my social media agency, I will need to send them, let's say, LinkedIn messages. And therefore I can do it in two ways. I can create a script, one single message, where I will change the name of the client and the business every time I send the message to someone else, and I will send the same message to everyone. And this way I can send the maximum amount of messages possible. The second way I might do it, which is the quality way, is to research every single person that I want to send a message to and find out what they like, what they don't like, what are their recent works, so something that I can relate to or talk to them about before I offer my services. So I'll send a more personalized message, for example, "Hi Mr. X, I really liked the last webinar that you did about this thing. My opinion is that. What do you think about that?" So just relate to them and so they feel that you're interested in their work and that it is not a robot messaging them. So this is the quality model. Now, obviously, because you need to put in more research into every single client that you're willing to send a message to, it will take more time, and therefore you will be able to send less messages than the quantity model. So for the quantity model, let's say you are able to send 100 client messages because you're copying the same message and you're sending it to everyone with a few changes. You will get a 10% reply rate since it's a low quality message and less people will feel intrigued to reply to you, and you will get 10 replies in following this kind of model. If you follow the quality model, for example, let's say you will be able to send 50 client messages, so less messages than the quantity model because they're more personalized, they take more time. You will receive a 20% reply rate, for example, because people will feel more intrigued to reply to your personalized message, and you will get, for example, 10 replies. So you're getting the same amount of replies in this case that I put out right here. You're getting the same amount of replies following the quantity model or the quality model. So it's for you to choose which kind of model you want to follow. Now, when it comes to trading, this is not the case, because let's say you have a 1-to-4 risk to reward ratio strategy on average. You will need a 20% win rate to be at break-even point. So for every 5 trades that you take, you will need 1 profitable trade to push you back to break-even. And therefore, if I follow the quantity model and I take 100 trades, and therefore since I'm taking 100 trades, they're lower quality, and I receive a 10% win rate, I'll get this result right here. I'll get 100 trades, I'll get 10 wins, I'll get 90 losses, and I'll get, eventually the result will be minus 50% on my account if I'm risking 1% per trade. Now, if I follow the quality model, you'll see that I'll take 50 trades, and since I'm taking the higher quality trades, I'll get a 20% win rate, and therefore this will be the result. I'll take 50 trades, and I'll win 10, I'll lose 40 and I will be around break even, 0%. So as you can see, when it comes to trading, you can't follow the quantity model. Your expectations shouldn't be, I want to trade as much as possible, I want to spend all my time in front of the charts trading, I want to do this, and I want to take the maximum amount of trades possible, because this actually will hurt you. It's not like other businesses. In other businesses, you might find a balance. As you can see, you receive 10 replies here, 10 replies there, so almost the same amount of clients. However, actually the same amount of clients in this case. But in trading, if you follow the quantity model, you get minus 50% in that case, and you get 0% in that case. So obviously, following the quality model is much more beneficial for you than following the quantity model. So the question becomes, how do traders go from here into here? Because most of you guys are right there, and this is why most of you guys are blowing accounts. Most of you guys are not profitable. Even if you're not blowing accounts, you're like minus 20, minus 30%, or minus 10% per month. This is why you guys are here. Now, how do you go from here to here? The question becomes, because how do you, instead of taking 100 trades, you take 50? How do you eliminate 50 trades that you're taking? Is it by just like lowering the amount of time that you trade? Of course not, because it will be random. Is it by choosing every 2 trades, you choose only one of them to trade? No, because this is also random. So the way I do it, and the way you should do it in 2023, is you ask yourself 3 main questions. The first question is, and I will be explaining exactly how to answer every single one of them in this video. The first question is, what are the main differences between my losses and wins? The second question is, what is the most common theme between my losses? And the third question is, what is the most common theme between my wins? So I will proceed with this video, and I will let you know, guys, how to exactly answer those 3 questions and receive a profitable strategy. Let's go. Now guys, let's answer the first question. What is the most common theme between my losses? How do you answer that question? I have thought about certain scenarios how you can answer that question, and I will let you know about them. Let's say you take 100 trades, because you should take 100 trades. Every time you backtest, every time you forward test, you don't judge unless you take 100 trades batch, and then after you finish with this 100 trades batch, you go on, you take another one, you take another one, you take another one, and you optimize after each and every batch. This is how you do it. So let's say you take the first 100 trades, backtesting or forward testing, you get 66 losses and you get 33 wins. So let's say you have a 33% win rate, and let's say you have a 1-to-3 risk to reward ratio. All right, let's say that's the case. Now, you look at your losses and you ask yourself, what is the most common theme between my losses? And you realize that for 40 of your losses, the market actually ran a little bit in your direction before coming back and hitting your stop loss. And you ask yourself, can I do anything about it? The market running a little bit in my direction and then coming back to my stop loss. Can I do anything about it? And you say, okay, I can take partial profits at 1-to-1 risk to reward ratio in that case. If I take partial profits right here, those 40 losses, let's see what happens to them. Okay, let's say on average, they run this much, okay? And you decided to take partial profits right there. What happens to them is that -1R trade right here, because you lost, it turns into a 0R trade, because right now it's a break-even trade. It becomes a break-even trade. You've taken 50% right here, at this area, and the 50% rest, it comes back and hits your stop loss, totaling in a 0R result. So now this -1R turns into 0R. So in that transaction, you've gained 1R. So for those 40 losses, actually, if you start taking partial profits, you will add to the cumulative results 40R, because all those losses turned from -1R to 0R. So you've added 40R to your cumulative result. Okay, I hope that's understandable. If not, pause it, think about it a little bit. Okay, you've added 40R to your results. Now what happens to your wins? What happens to your wins is that you decide to take partial profits right here. because you've decided to take partial profits on all your trades. So you decide to take partial profits right here, 50% of the position off at 1-to-1. Now what happens? You would usually get plus 3R because your average risk to reward ratio was 1-to-3. But now, since you're taking partial profits right here, this plus 3R turns into plus 2R because you're taking half of the position at 1-to-1 risk to reward ratio. So in that transaction right here, you've actually lost minus 1R in that case. For your 33 wins, the cumulative results, you're actually getting minus 33R. You're deducting 33R from your results if you decide to take partial profits right here. Because for every trade, I will try to explain it clearly, for every trade you used to get plus 3R and now you're getting plus 2R. So the difference is between taking partial profits and not taking partial profits is that you lose 1R if you take partial profits. So for 33 wins, you've actually missed out on 33R. Okay guys? That's the case right here. So if we look at both results, you're saving 40 losses, pushing them into break-even. However, for your 33 wins, you're missing out on 33R. If we add both results, you'll realize that the cumulative would be plus 7R. Okay, guys? So in that case, taking partial profits at 1-to-1 risk to reward ratio, if you have 40 losses that push in your direction on comeback and you have this batch of trades right here, it would result in a plus 7R addition to your cumulative. So if you're right now, you're getting, let's say, -2, -3% every single month, by just choosing to take partial profits, if you have this statistic right here, by choosing to take partial profits, you add 7R. So you're -3%, and let's say you risk 1% per trade, you now add every single month plus 7%, so now you're at plus 4% instead of being -3% every single month, just by choosing to take partial profits. Now let's say you realize that no, for those 40 losses, they actually run more than 1-to-1. They actually run into 1-to-2, and you decide, you know what, I want to take partial profits here, not at 1-to-1. What happens then is that those -1R trades, your losses, they turn into 0.5R. So this loss right here turns into a win if you decide to take partial profits at 1-to-2 risk to reward ratio. So the cumulative that you get is plus 1.5R from this transaction right here. You've turned your loss into a plus 0.5R trade, and therefore you've gained plus 1.5R during this transaction. So by saving all these losses right here and taking partial profits right there, to your cumulative result, you will add 60R. Now what happens to your wins if you decide to take partial profits at 1-to-2? If you decide to take partial profits right here, your 3R trade will turn into a 2.5R trade because now you're taking half of the position off right here. So you lose actually 0.5R for every win that you get. So you would usually get a win, for example, 33 wins, you're getting 3R per trade, now you're getting 2.5R per trade. So actually, if you compare the results between taking partial profits and not taking partial profits, for your wins, you're losing 0.5R. You're missing out on 0.5R per trade. So you actually miss out on -16.5R. So when you save your losses, you're adding 60R because your losses, your -1R is turning into 0.5R. But what's happening to your wins is that now they're down -16.5R. So the cumulative result will be plus 43.5R. So imagine by just deciding to take partial profits at 1-to-2 risk to reward ratio, you've added 43.5 RR to your cumulative result. Okay guys, now let's say, because realistically this won't happen, okay, realistically speaking, you won't be able to add 43.5R to your cumulative because you won't have 40 losses out of your 66 losses running into 1-to-2 risk to reward ratio. This was just an extreme example to highlight what can happen, what partial profits can do for you. Now let's say, realistically speaking, you lose out of your 66 losses, you realize that 25 losses actually run into 1-to-2 before coming back onto stop loss. This is more of a realistic example, more than the 40 losses example. So let's say you realize that 25 of your losses, of your 66 losses, they actually run into 1 to 2 and then come back to your SL. What do? Let's say you decide to take 50% of your position off at 1 to 1. Okay, therefore you turn every single loss into a 0R trade, into a break-even trade, thus adding plus 1R to every single loss you took before. Okay guys, now out of those 25 losses, it means you will save them, and those minus 25R that you would usually get, they would turn into 0R right now. So you're adding plus 25R to your cumulative result. Okay, now looking at your wins, what you're doing every time you take partial profits at 1 to 1 is the same thing. It's minus 33R. You're missing out on 33R. So what you realize here is that when you save your losses in that scenario right here, you add 25R to your cumulative result. However, what you do to your wins, you miss out on minus 33R. So if right here you add 25 and right here you minus 33, it will result that in total, if you decide to take partial profits at 1 to 1 risk reward ratio, you will be at loss. It's not a wise decision. And this is why, guys, when you message me on Instagram, for example, telling me, should I take partial profits? Should I do this? I can't really answer the question, because I should have these statistics right here to decide if taking partial profits at 1 to 1 risk reward ratio is a good idea for you. Because right here, as you saw, when I saved these losses, I added 25R to my cumulative result. However, what I did to my wins is that I missed out on 33R, and therefore I'm at loss if I decide to take partial profits at 1 to 1. Now let's say for those same 25 trades that are running right here, I decide to take 1 to 2 partial profits right here at 1 to 2 risk reward ratio, taking 50% of the position off. What that does is it adds 1.5R to each and every loss that I had before, because it turns it into a 0.5R trade, and therefore it will add 37.5R to my cumulative result. Now when it comes to my wins right here, as you can see, if I decide to take at 1 to 2 risk reward ratio 50% off, I will be missing out on 16.5. Right now, the cumulative result would be, I will be adding 21R to my total. So if I'm a minus 10% trader right now, and I realize that 25 of my losses, they run into my 1 to 2 risk reward ratio area before coming back to my stop loss, and I decide to take 50% of my position off at 1 to 2 risk reward ratio, just by doing this, I will be adding 21R to my result. So I'm going to go from a minus 10R trader to a plus 11R trader. So that's very good results by just choosing to take partial profits in that case. And so as you can see, I highlighted scenarios where taking partial profits is very good if you realize that it's a common theme between your losses. I've highlighted results where taking partial profits is actually bad for you, and it will cause you to go into more losses. And you can look at your statistics now when you backtest, when you take those 100 trades, and decide how are you going to do it. This is one of the most common themes between your losses, when the market runs a little bit in your direction and then comes back to your stop loss. Let's get into the second scenario here. Now guys, scenario number 2, what is the most common theme between my losses? Let's say you look at your losses, at your 66 losses right here, and you realize that 30 of them actually ran into your stop loss before pushing into your TP area. So what you decide to do then, you say, can I do anything about it? Can I save this loss? 30 of my losses actually hit my SL, then ran into my TP. Can I save it? And I say, yes, you can save it. You have a 1 to 2 risk reward ratio, let's say on average, and what you do is you increase that stop loss, you double it in size. Let's say I double my SL in size. Okay guys? So right here, after I've doubled my SL in size, what I did is that I usually had minus 1R for every loss, for those 30 losses. And now what I did, those losses, they actually turned into a profitable trade where I would get plus 1R, because now, since I doubled my SL size, I have a 1 to 1 risk reward ratio instead of 1 to 2 risk reward ratio. Okay, so I've gained with this transaction right here by just altering my stop loss size, I've gained plus 2R for every trade that usually ran into my stop loss and then pushed into my TP area. So this transaction right here, it got me plus 2R. So for the cumulative of trades, for those 30 trades that I usually lost, I've gained 60R as a transaction right there. Okay guys, because every single loss right now, I usually had minus 30R because those all were losses, and now I have plus 30R because now they're all wins. Okay, so I've gained 60R by just increasing my stop loss size. Now what happens to my win if I increase my stop loss size? Usually I got, for every win, I got a 2R. Okay, once I increase my stop loss size right here, now I'm getting a 1R. So for all my wins, what I'm doing, for my 33 total wins that I have right here, what I'm doing is, when I increase my stop loss size, I'm missing out on 1R per trade that I usually got. So I'm missing out in total on minus 33R. I'm missing out on 33R. Because usually every single trade I got plus 2R, and now I'm getting plus 1R because I increased my stop loss size, and therefore I'm missing out. For all my wins, I will be missing out on minus 33R. Now if I look at the cumulative result, right here I gained 60R by increasing my stop loss size, and right here I missed out on 33R by increasing my stop loss size. So is it beneficial for me? Yes, because 60R minus 33 is positive, is higher than 0. And therefore by increasing my stop loss size, in that case, I'm actually winning. Okay guys, so as you can see here, a simple increase in stop loss size can actually save a lot of your, can save your trading career, because this is 60R. In addition, you're getting 60 minus 33R in addition. So you're getting, let me calculate it, you're getting 27 right here R in addition. So if you're right now, you're a minus 20% trader, this move right here, giving the statistics that I just gave you, this move right here will add 27% if you're risking 1% per trade to your monthly results. And now instead of being a minus 20% trader, okay, my camera ran out of memory. However, usually you were a minus 20% trader a month, and now you've added a 27R, so you've added 27% to your results, and now you go from a minus 20% trader a month to a plus 7% trader. So this thing right here that I just did just saved my trading career, just saved my strategy. So it might be this simple. And guys, yes, I have saved a lot of strategies, and especially break and retest strategies for people like placing really tight stop losses. And I just do this because I looked at their losses and I saw that the majority of their losses, for example 30, are going to hit stop loss and go to a TP, and I just do this and the whole strategy is saved. Sometimes it's that easy. However, you don't notice it because you're not accumulating the data and you're not looking at it. Because when you accumulate data and you look at it, you will notice this. However, if you're just trading on a day-to-day basis and seeing, okay, how can I turn profitable? And you're not actually accumulating the data and looking at it after, you're not going to see this, you're not going to save it, and you're not going to be profitable. And this is why it's very important to take 100 trades and then look at them. Now, when does this not work? Let's say only 5 of your trades, 5 of your 66 trades actually hit your SL and went into your 1-to-2 risk to reward ratio TP right here, and therefore you're only saving 5 trades. You will only gain plus 10R with this transaction because you're adding 2R to every single previous loss. So you're getting plus 10R in that case. However, you're missing out on 33R. So in that case, you will be, in total, you will be minus 23R. Okay, so this transaction right here will give you minus 23R, and you shouldn't increase your stop loss size. So you should look at your statistics, see how many out of 100 trades are actually hitting your SL, and do these calculations that I did there, and realize whether that thing, increasing your stop loss, for example, if you see that it's a common theme between your losses, will actually turn you into a more profitable trader or not. So guys, what is the most common theme between my wins? And one of the scenarios that I can think of is the following. Now let's say you take 100 trades, you have 66 losses and 33 wins. Alright, you realize that for 17 of your wins, the market actually ran into 1-to-5 risk reward ratio instead of that 1-to-2. And you realize that for the rest, for the 16 wins that you had, the market actually just hit your TP or maybe went a little bit lower right here and then came back into your stop loss. Okay, and this happens with a lot of traders, guys. I've seen a lot of strategies where the majority of the trades actually ran way more than where people take profits, and they're actually cutting off their wins because they don't want to be in a trade for so long. Okay, so let's say 16 of your trades actually barely hit TP and went to your stop loss, and 17 of your trades actually just like ran way too much into your direction. Okay, let's say in that case it's 1-to-5. Okay, it was usually 1-to-2. So if you decide to increase your TP right here to 1-to-5 and start taking your profits at 1-to-5 instead of 1-to-2, you gain on these trades right here, you gain 3R per trade, because your usual trade was 2R and now you're gaining 3R per trade. So for your 17 wins right here, what you're actually doing is you're adding, because you're adding a 3R per trade. Let me calculate it here. If you do 17 multiplied by 3, you get 51R. So what you're doing, just by increasing the TP right here, you've gained 51R out of those 17 trades in addition. Okay, now for those 16 wins that barely hit your TP area and then went to your stop loss, those are actually going to be turned into losses. So usually you had the 1-to-2 risk reward ratio. Usually those trades would have got you 32R. Now those trades, they turn into losses, so now they're minus 16R. So the cumulative results of this, because you usually won 32R and now you're losing minus 16R instead, is minus 48R. So you're missing out on 48R by deciding to increase your TP. You're missing out on 48, you're gaining 51, and therefore, as you can see, increasing your TP in that case can be beneficial for you, and that can be the difference between a profitable trader and a loser trader. So for example, let's say you're usually a minus 3% trader, or minus 2%, let's say, in that case, minus 2% trader. You realize this, the following that I just told you, and you implement it. Okay, now you've gained, as you can see, minus 48 and then plus 51. You've gained 3% per month by just doing this, by just increasing your TP. So the difference is now you become a 1% trader a month instead of being a minus 2% a month trader. This is one of the themes. And then, guys, the back testing and the forward testing, it never stops. So then after you take your next 100 trade batch, those trades that actually run into your 1-to-2 and then come back to your SL, and the second question, and the first question I mean, what is the most common theme between my losses? This is going to become a partial profits area. So you're going to optimize as you go. Don't try to optimize them together. Don't try to say, okay, I will increase my TP and I will take partial profits at the same time and start trying to do the calculations together, because as you can see, it can get a little bit hectic and you want to take it as a step-by-step approach. When you're fixing your wins, you're fixing your wins. When you're fixing your losses, you're fixing your losses. Now, after you answer this question, what is the common theme between my wins, and you decide, okay, I want to add my TP, I want to add some profits right here, and I want to maybe do this right there. Now, as I was saying, camera ran out of memory again. So, as I was saying, guys, you want to go to the first question. After you increase your TP right here, you want to go to the first question and say, okay, what is the most common theme between my losses? And you realize this partial profit area, you'll take it, you'll see how it affects you, you'll do the calculations, and you do this. However, you do them one by one. Don't mix it up. The first question is, what is the most common theme between my losses? Then you fix your wins, or you can fix your wins first and then you fix your losses, and then this is how you go on about it. You keep accumulating 100 trades and doing this approach. Now, the third thing is actually what I currently do, what I do every single day. The third question is what I do every single day, what I still do to this day, and what I will do all my life. Now, these questions, don't get me wrong, they are so important to push you into profitability. However, after you're profitable, after you've optimized your strategy enough, where those questions, they don't actually do any difference to your strategy, you're profitable, you're okay, and they don't do any difference. Now, you want to push more into profitability by answering the third question, and let's get right into it. So guys, what are the differences between my losses and my wins? This is a question that you will have to answer forever. Even if you become profitable, even if you become the most profitable trader on this earth, you will have to sit down and look at your losses, you look at your wins, and ask yourself, what are the differences between my losses and my wins? This question is what takes traders from the quantity model to the quality model that I've talked about before. Because let's say you're taking right now 10 trades per day and you have 8 losses and you have 2 wins. Okay, when you ask yourself this question and you start filtering out your losses from your wins, and you're like, okay, I understand, this is how they differ. My wins look like this while my losses look like this, so I will start filtering out my losses. I'm not taking these lower quality trades. Now this number goes down because you're filtering out these trades right here. You're lowering down this number right here. You can't filter out all your losses, of course, because you can become 100% profitable. So let's say this number, it will go down from 10 trades, for example, per day until 4 trades per day. You take, let's say now, 2 wins and 2 losses that you weren't able to filter out yet. Okay, so and you will never, by the way, be able to filter out everything. However, you will be able to improve. Okay, and the thing is that as long as you're trading, whatever strategy you're using, it will start underperforming at some time. Okay, market conditions change and it will start underperforming. If you keep asking yourself this question, what are the differences between my losses and my wins, you will keep up with this change in market conditions. Let's say I'm trading for the next 4, 5, 6 months, and at the 6 months, another pandemic hits, let's say, and the market conditions start changing, the volume starts changing and all of that. As soon as because I keep asking myself this question, what are the differences between my losses and my wins, I will always be able to keep up with the market conditions changing, because I will always see it changing when it happens, and I will always be able to adapt and to improve and to filter out these unnecessary losses. Okay, the way I do it is by studying the environment that surrounds my trade. This could be the higher time frame, this could be drawing the liquidity above and below my trade, and this could be simply studying the price action in which I am triggered into the trade. For example, break and retest example. Okay, I don't trade break and retests. However, a lot of the traders that trade break and retest told me that this is a genuine optimizations that they did. Of course, I'm talking about profitable traders. The market is going down, they draw a support line, it breaks it down, and they're waiting for this retest. The only time they would actually take that retest is if the market comes back slowly like that into this area right here, because what's happening is that it's forming liquidity on the downside. Sorry guys to talk about your strategies, however, for the sake of the video. Now, it's forming liquidity through to the downside. It came back slowly into this test, and as soon as it tests, they take it down to take out all the liquidity. However, if it comes back in an impulsive way into the support line, they prefer not taking these trades. How do they prefer that? Is because they studied the differences between their losses and their wins, and they realized that most of their wins, they look like this, and most of their losses, they look like this. They noticed this difference right here in price action and volume as the market goes back to this support line, right there, and they just noticed it, and they said, okay, this is the difference, we're going to start taking these trades. And then they made the theory, okay, this is happening because liquidity is forming through to the downside. One of the optimizations. A second optimization might be, you go look at your wins, you go look at your losses, and you study the higher time frame. Okay, and you realize that, okay, for some of you guys, you're going to be an against the trend trader. For example, me personally, I don't really follow the trend. I try to be more of a reversal trader because my strategy works best when I look more into this reversal scenario. For your strategy, it might work best when trading with the trend. So by studying your environment and knowing that, okay, these are my losses, these are my wins, okay, the majority of my losses were caused by me taking trades against the trend, then maybe if I filter those out, because the majority of my wins are with the trend, so maybe if I filter those out right there and I eliminate them and I stop taking the trades that are against the trend, maybe I'll be more profitable because these wins are with the trend. So all you'll do is eliminate the unnecessary losses. Okay, another example is the liquidity. And this is something I've genuinely, like, I made this observation, is that for people who trade order blocks, you trade this break of structure, for example, and you expect the market to come back into this order block for you to trade it, for you to sell it down. Okay, now one observation I made is that if there's a double top right there, for example, okay, it's best not to take these trades. This is a low quality setup because the market will most probably, or it might, push up and take out this liquidity instead of going down from there. Okay, so you're better off trading an order block when there is no liquidity, there is no, this double top doesn't exist just above your order block right here. So you study the environment, you've studied the liquidity, and you've noticed that, okay, the majority of my losses, or a big number of my losses, is caused by me trading an order block right after a double top. So you stop doing it, you eliminate those losses, you filter them out, and you move on with your trading career. Okay, so this is what I can think of right now. I will of course update you on Instagram always in my stories if I make other observations. However, when you're studying the environment, this is what I currently study: the higher time frame, the liquidity above and below my trade, and the price action. How is my trade being triggered? Impulsively? Is it slow? What is actually happening? When you study those things and you start making these observations, okay, this is how my losses look, this is how my wins look. Okay, I'm seeing the difference. Okay, right here there's double tops in the majority of the cases. Right here there is no double tops in the majority of cases. Can the double top possibly be the reason why I'm losing these trades? What if I stop trading the double top? How will they look then? Okay, I eliminate 6 of my losses if I start trading a double top. However, in my wins there is no double top, so they remain the same. Okay, so I win if I remove these losses, if I filter them out. So it's a question that you'll always have to ask yourself to move from the quantity model until the quality model. Those are the 3 questions that I ask myself, guys. I hope you took notes. I hope you will do it this way. And as I said, for any questions, guys, for any inquiries, for anything that you need, feel free to DM me on Instagram. The link will be in the description. Now there's a few notes that I want to give you here, and let's get into it. So I have a few notes for you guys here. Let's get right into them. Don't take a 1000 trade batch and analyze. What people do is, you think that if you take 100 trades, this doesn't actually Okay guys, I have a few notes for you here, so let's get right into them. First of all, don't take a 1000 trade batch and analyze. There's a lot of you guys who think that, okay, of course, 100 trades, if you just took 100 trades, let's say it took you 1 month to do this forward testing, or let's say this is the data that represents only 1 month, and therefore it doesn't represent all the different market conditions and all the seasons. And this is true. It doesn't represent the winter, the summer, when pandemic happened, when the elections happened, when some Russia and Ukraine stuff happened, when all of this happened, 100 trades aren't going to represent all these market conditions. So you might be inclined to take a 1000 trade batch because you want to like diversify your trading batch and then analyze on it. What I would prefer you to do is to take 25, for example, in the winter, 25 in the summer or some season, 25 during COVID, 25 during the elections. This is how you diversify. You don't take a 1000 trade batch to represent all market conditions, because what will then happen if you have 1000 trades, it will be really hard to analyze. It will be really hard to look at 1000 screenshots and determine like what are the differences between your wins and losses. However, if you're looking at 100 screenshot and you have, for example, 66 losses, so when you're analyzing your losses, you're only looking at 66 screenshots, and when you're looking at your wins, you're only analyzing 33 screenshots. That's not too bad. However, if you have 1000 and you're analyzing 330 wins and 660 losses, this will be hard for you to keep up with the patterns. It will be really hard. So move in 100 trades batch. You can diversify it on different market conditions. However, this is how you should move. So you're able to look at the patterns and you don't have a really big batch size, and then you will be confused, okay? Don't just rely on your 100 trade batch. You've taken that 100 trade batch and you've optimized, okay? You need to take another 100 trade batch and then optimize again, and then 100 trade batch and then optimize again. So after every optimization, you take 100 trades, you take 100 trades, you take 100 trades. You keep doing this until, for example, you have 3 consecutive 100 trades where you're profitable. Okay, where you didn't need to optimize, you felt like everything is in check and you're profitable, and then you're like, okay, I want to take this to the live markets. All right. The third note is clean data is important. A lot of you strategy hop, a lot of you guys look at different strategies and try to do different things. This is really bad for your trading career, because clean data is very important. If I'm accumulating 100 trades, I want to make sure that those 100 trades are according to my exact strategy and optimization. If there's 20 of them, for example, where I've improvised, or I increased my stop loss, or I closed my trade in the middle of nowhere without sticking to my strategy, or I don't know, you did something weird, like you've taken partial profits when you weren't supposed to take partial profits, all of that shit, you will have 20 trades. So 20% of your batch that you're accumulating is actually not a good representation of your strategy. So you won't have a good optimization, because you won't optimize accurately. You're optimizing your improvisation. You're not optimizing your strategy. Okay, guys? And improvisation, it changes over time, and therefore it's bad to just try to optimize your improvisation. You need to optimize your exact strategy, and therefore clean data is very important. Don't jump between strategies. Don't improvise. You need clean data to have an accurate representation of the strategy so you can fix it. Okay? Don't go from 0 to hero, improve and move. You accumulate 100 trades, guys. You ask yourself the 3 questions. You've optimized enough for your strategy to go from, for example, minus 20% to minus 3%. You move on. A lot of you will be stuck here and you'll start saying, okay, but how can I actually move it into plus 10%, for example? You don't want to do this, because there's only some optimizations that you can do. You can't go from this to this in a 100 trade batch. Some of you will be able, some of you will look at your loss, increase your stop loss a little bit, and it will push you into profitability. But however, for the majority of you, you're going to be able to fix it a little with every 100 trade batch, and not like completely fix it. Now, after you've went to minus 3%, you accumulate again. You accumulate another 100 trade batch. Now, you start from minus 3% instead of starting from minus 20%, and you want to optimize it up. Okay, so now you're optimizing that batch, trying to optimize from minus 3% possibly to break even, for example. Then you take another 100 trades. Now you're starting from break even, because now your strategy is a break even strategy, and you want to optimize until profitability. You optimize that trading batch right here. You try to optimize it into profitability. Don't try to rely on one 100 trade batch and try to go from 0, from someone who's losing 30% every single month to someone who's winning 15% every single month. You don't want to try to do that. You just answer the questions that I gave you, you do all the math that I gave you, and then simply you're okay. Now you're a good trader, minus 3% instead of minus 20. You then move on. Okay, now third advice or fourth advice is lower your expectations, the quality model. Okay, first of all, there's a lot of you who want to trade every single day. for example. You want to take a certain number of trades. You want to lower your expectations. You want to look at your 100 trade batch. You've optimized. Remember, you've asked yourself, what are the differences between my losses and my wins? You filtered out your losses, and therefore for every 100 trade batch, you're going to start taking less and less trades. So for example, if you're taking 10 trades per day, you might need, for the first batch, you might need only 10 days to accumulate your 100 trades and optimize from there. But then since you filtered out your losses, now instead of accumulating 10 trades per day, you're doing 3, for example. And now instead of just taking 10 days to accumulate 100 trades, now you need 33 days to accumulate 100 trades. Let's say you filter out some more of your losses, and now you're a trader that takes 1 trade every single day. Now you need 100 days to accumulate 100 trade. Let's say now you start taking with the next batch, you start taking a trade every 2 to 3 days. So now you need even more time to accumulate 100 trades. So lower your expectations on the number of trades that you want to take per day once you're live trading, especially. Okay? Now, the second expectation that you should lower is percentages. A lot of you try to aim for certain percentages. A lot of you will reach this, for example, plus 1% point per month, and you'll say, no, I want more. And you will be stuck in trying to get more and keep being a loser till the end of your life because you want more. Okay, you need to just say, okay, plus 1% is actually very good, because if you have a 100K fund, 1%, you're making $1,000 a month. If you have an even bigger fund, you will get even more money. So 1% is good. 95% of traders lose. If you can be in the top 5% of profitable traders, then you are a top 5% in something. If you're top 5% in anything in the world, the demand for you is going to be really high, because the supply of you're top 5%. So the supply, the number of profitable traders that exist on earth right now is not very high compared to the demand. Investors are looking for traders left and right. And therefore, this 1%, now you're top 5% of traders, now you're part of some people that a lot of other people are looking for. A lot of investors are looking for you. So now you aim for those investors and you get capital, since you're now top 5% at something. Okay, don't try to go from minus 20%, oh, I want to be a plus 30% trader every single month. This is not possible. Okay, so aim for those lower percentages, lower your expectations. Once you get them, you aim for this, for those investors, you get capital, and this is how you move. 1% of a lot of money is a lot of money. So you will be able to live off of it. Don't worry, lower your expectations. And the final thing I want to say, let's say your strategy backtested it gives you, let's say 5 trades per week. Okay, you want to lower your expectations to 1 trade per week, because you want to be on this high quality mindset that I don't care about trading every day. 5 trades a week means I have to take 1 trade every single day. However, if you say in your head, okay, no, I want to only take 1 trade per week, you might get more if you're analyzing the market. However, your expectations are, I only care about getting 1 profitable trade per week. This should be like your expectation. It's a good mindset to be in, and then you move on. This is my mindset. I aim for 1 trade per week. I get 5 to 6 sometimes, but I don't care. I don't aim for 5 to 6. I aim for 1. If I see 5 to 6 high quality setups, I will take them. However, I only aim for 1. So I'm not mad if today I open the charts and I don't see any setup. I'm not mad. It's still Monday. I have 4 days and my expectations are 1 trade per week. Okay, so this will be the end of this video, guys. If you've liked it, feel free. I'm actually tired, so feel free to subscribe, notifications, and if you want to, as I said, if you want to contact me or you want to listen to my Q&As that I do on Instagram, link will be in the description. All right, guys, have a great week, have a great day, have a great year of 2023. Let's do this. Message me if you do. Let's celebrate together. Good luck, guys.